but you can use this to really build that portfolio, build a lifestyle, build wealth, build assets. Welcome back here to our series on the STR loophole. We have talked about understanding reps, short-term rentals. We've talked about understanding just rental investments as passive and how they can create losses overall, how you can use those losses. We've talked about depreciation and bonus depreciation, and now we are going to get into cost segregations, which is really what makes the short-term rental loophole. A cost segregation study is an engineering-based study which allows you to break out components of a building into 5, 7, 15-year property and use the rest as land in the building, which 39-year property for the short terms, 27.5 for long terms, but it allows you to break that up. And then from there, you can depreciate things differently, right? But if you just want to go in and do it without that study, you don't have a way to do it. It's all building, no bonus. You need a cost segregation study, which will break the components of this building up, and then we can get into bonus depreciating things. So jumping back into our example where you bought a short-term rental for $500, right? We bought it for $500K, decided that $100 was land and $400 was not decided, but determined that $100 was land and $400 was the building, right? And that's what we're doing. We're depreciating the building over 39 years. But here's what happens. You didn't actually pay $500,000 for a land and a structure. There are a lot of pieces in that building. There's flooring, there's cabinets, there's fans, there's driveways, there's all kinds of things that are a part of that, right? That's what you paid for. If there's furniture in there, that breaks out, right? So you didn't just pay for this random structure. You paid for everything else that went into it. If you had went and built it and put those pieces in, they all would have had different lives. So what a cost segregation study does is the engineering firm comes in, gives a report that says, hey, this isn't a $500,000 building that went $100,000 to land and $400 to building. Actually, it's a place where the land was $100 and then there was 5-year, 7-year, 15-year property. They'll break it all out. There's fireplaces, there's fans, there's all this other stuff, there's fencing, right? They break it all out and all of that gets grouped into a different category. 5 years, 7 years, 15 years. So when they give you that final report, it now looks like, okay, we had land at 100, we had 5, 7, and 15-year property worth maybe another 100, and then the building was worth 300. So that's what this study looks like that you get. It gives you a report that says, okay, this is how it breaks down. It's not land and building, it's land, building, 5-year, 7-year, 15-year. That report then goes to your accountant, or it should be going to an accountant, a CPA, someone who understands real estate cost segregations, bonus depreciation, and can report them properly on your tax return. The accountant then takes that report and says, oh, great, because that $100,000 that they broke out into 5, 7, 15-year property, we're taking it all right away as bonus depreciation because 5, 7, and 15-year property all qualifies for bonus depreciation. The $300,000 building, it still doesn't. 300 divided by 39 years, but we just got $100,000 of a deduction from being able to get bonus. So that's where 100% bonus is a huge, huge deal. As we put this together and what the tax savings looks like on a deal like this, it is significant. So if we're looking at our example, before the cost segregation study, you had a building of 400 and you had the land of 100, right? Divide the 400 by 39, that's $10,250 a year. So $10,250 is your deduction. If you're a 35% taxpayer, you get about $3,500 in savings year one. Great. That's money in your pocket, $3,500. But now what do we have? We have this cost segregation report. So now what's depreciation look like? It's not $10,250. It's $100,000 right away from the 5, 7, and 15-year property that we're bonusing. So we get $100,000. Then we take the $300,000 and we divide that by 39 years. That's another $7,700. I think so. Now we've got $107,700, right? That's our depreciation. We don't have $10,250. We have $107,700. That times 35%, much bigger, right? $38,000 or something. So we're talking about a difference of almost $35,000 in the tax savings from year one. That's being pretty conservative on the cost segregation study. So cost segregation might break out even more. It might break out more than $100,000 as 5, 7, 15 years on this, right? You never know. It depends on the property type and what's all in it and what's included, right? And there's all kinds of lucrative things that get a lot more cost segregation breakouts, but just being somewhat conservative on this, that's significant, right? $30-some thousand, that's another property you can go buy, right? So now we're going to talk about, now that you understand that cost segregation, you understand how that can work and the power that can give you, the tax savings that can give you, you can start to see how you can get this money in your pocket, right? And from there, you can start to see how you can use the short-term rental loophole to build a full portfolio, right? Not just go, this is a one-off thing, but you can use this to really build that portfolio, build a lifestyle, build wealth, build assets. So be sure to catch the last few videos in the series here, guys, because we're going to talk about putting this all together. We're going to talk about using it to build that whole portfolio. And lastly, we're going to talk about audit proofing yourself. So that's definitely that last video is probably the most important of all, because we're going to talk about what does this look like? What happens? And if you need to go under audit, what's it going to look like, right? So that is going to be key. Make sure you follow along and catch the next one here.